Everybody, welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Ashmead Pringle, who's the president of GreenHaven LLC. Ashmead, thanks for coming on the show.
Thank you, Mike. It's good to be back.
Yeah, you
with
were
you
here quite some time ago, almost at the beginning of this interview series that we have here on a regular basis, I think back in 2008. And so you and I were just talking recently about what has transpired over that course of time, 3.5, almost 4 years. A lot of volatility, but commodity prices in general really kind of at the same levels they were back then.
Yeah, Mike, it's almost like what hasn't happened in those 4 years since we launched in January of 2008. Almost our 4-year anniversary is maybe a week away. And the index that we track in our index fund really is about the same, although different commodities and different groups have been up or down during that period. Clearly the precious metals have been higher, the ags have been higher, other commodities have been lower, but overall the basket's about where it started 4 years ago, just as the equity markets, with a lot of volatility in between.
Right, now your index, your fund is based on the original CRB index, is that correct?
That's right, it's the old CRB, the classic, the one that was started in 1957, is an equal weight commodity index. It's still an equal weight commodity index, although its name was changed in 2005 from CRB, which was put on a new index, to the CCI, Continuous Commodity Index. But even though the name changed, the index is still the same, equal weight 17 commodity index. So it's got a little bit of everything in it. It's got the oils, it's got energy, it's got ags, the softs, meats, metals. So it pretty well covers a broad spectrum of commodities.
Now that would differ as some of the other indices have a higher weighting, for example, in energy. Yours is probably less weighted in the energy complex, correct?
That's right, because our index was built that way. It's 3 of the 17 components are energy. There's crude oil, natural gas, and heating oil. So we're a little less than, I think, 18% energy. The other ETPs in the broad index tracking space tend to have more energy because they designed their own index versus the one we license from Reuters. And they tend to have anywhere from, say, 33% energy, maybe to as much as 65 or 70, depending on what happens during the year. They don't typically rebalance their index except once a year. So their weights can drift within a year depending on what the relative performance is of sectors.
Right. Well, let's talk about the outlook, and especially given what has happened over the past 4 years. You know, we saw that almost the near collapse of the global financial system. We saw central banks engage in a huge monetary easing, quantitative easing, the European debt crisis. More recently, of a geopolitical nature, we see tensions with Iran, threats to block the Straits of Hormuz. Given all this, we definitely, there was a lot of volatility. What about prices? Are you surprised that the general level of prices really kind of remains the same as it was several years ago? We heard all this stuff about money printing by the central banks, but yet actually the dollar is higher now than where it was in 2008 when the Fed started to really lower interest rates and embark on quantitative easing. Are you surprised that the price level is really kind of about the same?
Well, I am in a way, Mike, although some of the components that make up a basket of commodities I expected to be higher and some to be lower. I'm surprised gold is as high as it is. Not surprised
really?
From 4 years ago, okay. But I'm not surprised that the ags, the corn, soybeans, wheat are double and triple what they were 4 or 5 years ago. Or that the dollar is strong. I think the thing about the dollar is I feel like currencies in general will be weak going forward against hard assets, but that the dollar may be the best horse in a race of weak horses. And I think we're beginning to see that in some cases now with the euro, except for commodity-rich countries, Canada, Brazil, Australia, I think the U.S. dollar will continue to do well against most other currencies.
Now let's look at, I would say, the economic environment right now where we see policy more towards fiscal contraction, and we're seeing the effects of that in weak economic growth in Europe, slow economic growth here in the United States, in Japan, even in China. Now, these policies are expected to continue, at least for the next year or possibly several years. Don't you think that's going to kind of create the same effect on markets as we've had, at least over the last year?
It could, Mike. I think austerity does worry me, because I think while bitter medicine sounds good for people, it really isn't good for an economy.
Right.
And austerity, a government retrenching tends to make a recession more prolonged and deeper. So I would like to see Europe going in the other direction. Clearly, in a recessionary environment or even a deflationary one, commodities face a strong headwind. But personally, I hope and I feel that the ECB will ultimately inject more liquidity and tend to err on the side of inflation rather than deflation.
Yeah, the problem is, though, when they inject the liquidity at the same time, they require certain conditions of the governments, and that is more spending cuts. So whatever liquidity is going in there is being sucked out by the austerity. But it's interesting because you said you're not surprised that certain commodity sectors like the ags have gone up as much as they have, which kind of suggests that you believe there are real fundamental factors there driving the ags, as opposed to, let's say, some of the gold markets or other markets that people kind of look at as a monetary hedge. So talk about that a little bit. Are there fundamental factors in place now for the long term driving agricultural prices higher?
I think so, and I think they have driven them higher. I think we had a secular shift in agricultural prices in that 2005, 6, 7 period when crop prices moved up substantially for a couple of reasons. One is global stocks had become fairly skinny, and at the same time demand has been growing and coming from China, from developing Asia, from India, and production just hasn't been there to meet it. Now we've had a little respite with some better wheat stocks nowadays and so forth, but that demand is going to be fairly relentless, we think, particularly from China. If China follows South Korea, Taiwan, and Japan, it will end up importing 70% of its grain needs, and 70% of China's grain needs is a very, very big number.
Yeah.
So we continue to think that there'll be firm support under ag prices, and that the constraints are arable land and water. Water is a very key resource, and China has got little of, compared to its population, little arable land and little water.
Have you heard about Congress now eliminating the subsidy for ethanol, domestically produced ethanol, and what impact do you think that'll have on corn prices? I think they're also removing the tariff on Brazilian ethanol.
That's right, Mike, and it's been talked about for some time. So I don't think it's a surprise to the industry. I don't think it really will affect corn prices. And that subsidy's gotten some bad press, but it was originally created to help stimulate corn demand. It was back when corn was under $2 a bushel.
So if you take it away, won't that take away some of that demand?
I don't think so. I think ethanol has earned its place now in the market for a couple of reasons. One, it replaces MTBE, and right now there's really no other substitute besides ethanol. When Uncle said you can't use MTBE anymore, practically speaking. So that's ethanol at any price demand.
Right.
Then you have, to meet the blend of 10% mandates in many parts of the country, basically you have to go with ethanol. Then above that, you could have some marginal demand that you might lose. And also ethanol is it's an octane enhancer. While ethanol isn't as valuable as gasoline in energy content per gallon, it's a high octane item. So you can use ethanol to blend up, say, regular grade gasoline to a higher octane, and that's worth something to the
That's why they
refinery.
use it in those dragsters, right? I mean, top fuel eliminators, right?
Yeah, right.
All right, so let's talk now. Swing to oil, crude oil, where prices have been kind of in a range between $85 to $100 a barrel, at least here domestically. But a lot of potential, scary things out there on the horizon geopolitically with Iran. Some threats we've had to block the Straits of Hormuz. If something happens there, clearly you could see some crazy prices in oil, couldn't you?
Well, you could, and I don't know that anybody can predict them, but there are reserves. The U.S. does have a strategic reserve that's pretty sizable. I think over 700 million barrels that they could release. Europeans have some. And it's hard to assess. I think certainly there's a risk premium in oil markets these days, and rightfully so. But it's just hard to say where it might go. Whether Iran will cut off its nose to spite its face, it's difficult to say.
And chances are, if they tried something like that, it wouldn't be sustainable for any length of time, probably a week or 2 weeks. At least that's what I've heard.
Well, I think the plain truth is probably that the Iranians need the export revenue more than we need their oil.
Good point.
And the Arab countries as a whole now have tended to spend more money socially to try to keep the peace, avoid the revolution, or at least dampen it a bit. So they need high oil prices. So and they need oil flowing. And I don't think for the group as a whole they mind too much a little saber rattling. That does get the price up.
It certainly does.
But I don't think anybody will benefit from a stoppage of oil flows.
All right, so right now, looking out over the broad spectrum of commodities, let's say for the next year, what areas are you most bullish on?
Well, that's a tough one, Mike, because it's everything is, as they say these days, so binary, and you see it in the markets every day. One day we're going to run to the right side of the boat, and the next day we'll run to the left side of the boat.
Risk off.
And one day Europe is going to be fixed. They'll fix their problems, and the next day, oh no, they won't. So it's a difficult thing to say, and I think, I'm not sure everything will go higher. I think ultimately we do, because I think ultimately we either meet these challenges with more liquidity and hence create a little inflation that's good for commodities long pull, or we may go through some more austerity and recession-like times, and then things recover. So 2 or 3 years out, perhaps, or 1 or 2, I think we're going to be in uptrends, maybe sooner. Oil long-term, I think, certainly has the wind behind it, because I believe oil supplies will be constrained and demand will continue to grow. The ags will depend a lot on weather and global stocks, but that demand is relentless too. I wouldn't be particularly bullish about the precious metals, because I think they're bid up as essentially currencies.
All right, stick with ags and oil. Ashmead, thank you very much. That's it for now, folks. This is Mike Norman signing off. We'll see you here next time. Bye-bye.